Good afternoon, everyone, and welcome to the March BizVal webinar. It's a few days before a long weekend, and I'm sure many of you are looking forward to taking a couple of days off and a nice little break. I'm Stephen, the co-founder and CEO of BizVal, and today I'm joined by my co-founder, the Finance Ghost. We're going to be unpacking the sometimes thorny topic of how to value a startup. We all see the headlines of massive VC raises and, the so-called paper unicorns. But how exactly does one think about valuing a startup, and how should one think about valuing a startup? This is going to be the first in a three-part series on how we as BizVal think about valuing a startup. And we look forward in the next couple of sessions to inviting a couple of, guests to come and chat to us about it too. I think our usual housekeeping. So for those of you who've been with us before, the chat section, you'll know these rules, but the chat section is set to private. So only the presenters and moderators can see your messages. Please feel free to add questions as we go along. So we don't just keep questions for the end. If it's relevant, we'll pick it up during the flow of the conversation. So please send your questions to the Q&A and we'll pick those up. We are recording the webinar and it will be made available on YouTube in case something comes up and you need to drop off the call. I know we had a few gremlins with our webinar software yesterday where some of the messages and that went out early. So you guys who are here obviously weren't impacted by that. But if you have any friends who for whatever reason clicked on a recording of nothing yesterday, you know where to direct them to. And then please check out the poll. This week's poll is, how do we define a startup? So the question this week, we'll cover that ourselves just now, but please go and answer the poll. If any of you have missed any of the previous webinars, these are available both on our website and the YouTube channels. All right. So before we get started, the first question I think we need to ask ourselves is what is a startup and why is it important to value a startup? That's why we're having this series. So I'm going to plant a few sort of thought starters before we hand over to the ghost. But a startup has got some characteristics. It's often an unproven or untested business model. We hear things about trying to find product market fit. So is what you're selling or the service that you're offering, do people actually need it and do they like it? We talk about culture and innovation, testing new things. Things like it may be pre or post revenue, so have you actually generated any income yet or not? And often it's not yet profitable. Often it requires funding to be able to get it to the point that it's actually a sustainable business. So those are some of the characteristics of a startup. Why is it important to value a startup? And I think our departure point here today is we believe that it's really important to address the sort of information gap between funders and founders. Often with startups, somebody's starting a business for the first time. Funders, on the other hand, often have been through a number of these, valuations and funding rounds. So part of what we're trying to do is to address that information gap, to empower the founders to make a better decision, and even ask the hard questions. Do they even need to raise capital? I think at our last webinar, we spoke about, hybrid bootstraps versus bootstrapping versus VC-funded businesses. So that's part of the reason why it is important to actually value a startup and understand the value. The other is to put numbers to a canvas. A lot of the time, a startup is just an idea. It's been scribbled on a whiteboard. So putting numbers to that is helpful, but there could be a number and a multitude of other reasons, starting with a value creation mindset. We're not going to go into all of those, but I think it's also important to say what it's not about. And I think, the reason for valuing a startup is not so that you can brag with your mates about how big a unicorn you've got in your backyard. So without any further ado, I'm going to hand over to the ghost, who's going to talk a little bit about some of the challenges of valuing a startup and how we at BizVal think about valuing a startup.
Thanks so much, Graham. Yeah, we'll have to rename ourselves to VizBal, although I think maybe we stick with what we've got. So, thanks so much, and thanks to the attendees for joining us as well in this funny old week with Easter just around the corner, and we'll jump straight into it. So obviously valuing a startup is actually really hard. I think it's quite a bit harder than actually valuing something that has got a nice track record of cash flows and a pretty good idea of where it's going. Startups are all about, I think volatility is one point, sure, but just forecasting risk. You're kind of embarking on the unknown, and you're having to make educated guesses at best to try and figure out what the next few years might look like and how do you actually value that. So, this is something that we obviously asked ourselves a lot since we launched Bizval, is would we kind of get into the startup game as well, and what would that look like, and how would we go about doing it? And I think a lot of what we do and the way we think will hopefully come through in this presentation. So the first point is very much around just being careful of revenue multiples. Startup valuations are difficult, they're shrouded in mystery. And what ends up happening is, and I think this is very much VC culture, is a deal gets done, it gets announced, and inevitably the revenue multiple and how much money was put in is mentioned. For some reason among startups, there's kind of this competition around who raised the most, whether they needed the money or not. It's almost like this, this contest. And the problem is that we then have a whole lot of revenue multiples running around in the market. People go onto one of the venture magazines or deal tables and they go and pull a revenue multiple. Now, the problem with that is, firstly, that deal was for a business that doesn't look the same as yours, no matter how much you think it does. So that's one challenge. But even there's a first principles problem with this approach, which is to say, why is our baseline assumption that the comparative deal happened at the correct valuation? Why are we assuming that that deal was right? That's the first problem. Second problem, valuation multiples can vary dramatically across jurisdictions. So a revenue multiple in Silicon Valley is not the same as a revenue multiple in London, Berlin, Cape Town, Sydney. It's different. You've got an emerging markets versus developed world issue. And to be honest, Silicon Valley kind of dances to its own tune. On macroeconomic conditions, that's another big one. In 2020, when interest rates were basically zero, you could get a much higher revenue multiple than you're going to get today. And there are very good macroeconomic reasons for this. Money is now more expensive than it was 4 years ago. So if you go and pull out an example of a transaction from the pandemic and you try and use that to justify what your revenue multiple would be today, you may well get yourself into serious trouble and have a tough conversation. The other problem with revenue multiples is they just don't allow for differences in the business. If you can imagine that your business is a full-size piano, the revenue multiple is kind of like one octave on one of those little kiddie pianos that you play along to. It doesn't give you the full story at all. The other businesses that traded at a specific multiple, they would have had structurally different unit economics. They would have had different margins, different scale opportunities, different founders, different products. So at the end of the day, there's actually so much more to your business or any business that you are looking at investing in than you would necessarily know about this comparable business that people point to as an example of a revenue multiple. So this leads us nicely into being able to talk about the approach that we take. So I think, Graham, we can go to the next slide on that. There it is. And this is around optimism meet realism. So this is very much, the way we do this thing. And our approach starts with the founders, because I think that is really what sets a startup apart from a more established business. Sure, the management matters in an established business, but in a startup, the founders really are pretty much all you've got at this point in time. So we engage directly with the founders and we ask them a lot of questions. This includes the hard ones, by the way, about the business. So not just, what are you planning to do and how exciting is it? And this is so wonderful, but actually what can go wrong? And we'll get into more of that later. And in doing that, we then assess the level of experience and expertise behind the forecasts. It makes a very big difference when you're speaking to a much younger founder who maybe hasn't spent a lot of time in that industry but has an idea for it versus someone who's been in that industry for like 20 years. I think we can go to the next one, Graham. So this is a really important concept. Spreadsheets are easy and real life is hard. So when we work through these forecasts and we actually unpick the business plan, we are looking for a lot of the so-called off the spreadsheet stuff that people don't always think about. So entry of competitors is a perfect example. We're going to watch it play out, I think, with someone like Novo Nordisk and Ozempic, the weight loss drug. That thing that has been valued now as though it will be the only weight loss drug in town for the next 100 years. Actually, there are competitors coming at it from every angle. The important point here is that if you've got a really lucrative business model and you're making a lot of money, you're not going to do that in a vacuum. People are going to see what you're doing and they're going to come for those profits as best they can. So we always get a bit nervous when we see forecasts that don't make proper allowance for things like entry of competitors. What will that mean for your pricing, for your growth rates? What will it mean for your cost of acquiring a customer down the line? Another great example has been Tesla, where everyone thinks that will be the only electric vehicle in the world. That's not realistic. We had 100 years of the automobile before that to tell us that people do like having different brands, different shapes, sizes, colors. Why assume that Tesla would basically be the only show in town? So we very much look at this and say, where can it go wrong? Not just where can it go right? I think on to the next one is this concept then of cautious optimism. So this is kind of the balancing figure here. It also doesn't help to be highly pessimistic about the value of a startup because startups by their nature are very optimistic things. These are people who are genuinely changing industries. They've created something new and exciting and they change the world. Pessimists do not change the world. Optimists change the world. But we need to be cautious when we look at this. So, what we do is we accept that, yes, we can't see everything that's on the spreadsheet right now in real life, but it's very silly to say, oh, well, therefore this is worth nothing. This idea is not going to fly. That's also not how the market works. So what we do is we try and get down to the detail. We build out a financial model that makes it as simple as possible to actually test the drivers of value. So we look at stuff like unit economics. We look at stuff like what will your margins be at scale? What will your overheads probably be along the way? And the idea here is to, yes, be optimistic, but to be cautious when we're making these forecasts with the founder. And we end up with a very cool, very detailed financial model over, say, the next 5 years that basically allows us to do the valuation and actually get an understanding of why the valuation is what it is. So we go on to the next point, which is the allowance for optionality. So again, bit of balance here. When startups do well, they really do well. So again, it doesn't help to sit back and be like, well, all of this is completely unrealistic. There's no chance that you can achieve what you've put down here, because that's not how startups work. Sometimes they do achieve those things. So we build in this sort of blue sky case for basically, 5 years out and allow ourselves to dream a little bit along with the founder. What could you actually achieve if you hit all your targets? Then we put a weighting on it. And the important thing here is how robust is the business plan? How good are these founders? How well do they understand what they're actually building? How much flexibility is there in the business case that will allow them to pivot down the line or add on or hit a different geography or a different customer vertical, for example? And then we say, okay, assuming that, or we build out that blue sky case, and then we put a weighting on it based on all of those factors. And I'll talk more to that later. First, we need to go on to the next one, Graham. Testing for dilution is pretty important. So some businesses are really just incredibly capital hungry and they will need to raise money more than once, more than twice, sometimes more than 3 times. In fact, often more than 3 times. So what we do is when we're building out this financial model, we actually use it to reveal the likelihood of future capital raises. There's that kind of initial raise of, okay, I need to build out whatever product it is I'm doing. And then people assume, okay, then I'll hit the market and suddenly I won't need any more money. That's not how real life works. You need working capital. It takes longer to sell than you think it's going to, especially when you're in a B2B game. Anyone on this call who has tried to sell a B2B service will understand how much longer it takes than you thought it was going to take. When you're selling B2C, that also takes time to actually build up. So we make allowance for that and actually point out where we think the risk is of future capital raises and what that dilution might look like for shareholders along the way, and what that also means for the future values of this thing, and of course, the risk. Final point is around sensitivity tables. So a startup is always going to be a leap of faith. Investors are always going to have different risk tolerances. So our final output, we are definitely not arrogant enough to say, okay, we've determined that the answer is that this thing is worth $1 million and that's the answer. No. It's an answer, but no one knows what the answer is. So what we do instead is we say, here's what you need to believe to be true in order for this to be the valuation. Here's our model. Here's how we stress test the margins, for example. You might have a founder who has a very good sense of selling price, but hasn't produced anything yet. So in that case, the selling price you might have a fair amount of belief in, but you might be very scared about what gross margins look like. By stress testing the gross margins, you can see the range of values on the business. Similarly, that blue sky case that I talked about earlier, the weighting that you are willing to put on that blue sky case is going to affect the valuation quite considerably. So some investors may believe more in the founder and be willing to put a higher weighting on the really big dream. And then that spits out a higher value, obviously. For founders, this is very helpful because when we're showing a range of values, what we're basically saying is, if someone makes you an offer at the lower end of this range, then you know that they are a more cautious investor. They are not really giving you lots of credit for the big dream. Conversely, if someone puts in a big offer towards the upper end of this range, it looks like they really are buying into the big dream. That looks like a really strong offer, and you should probably, really consider it and actually think about doing this deal. So I think the next slide should hopefully then show all 6 in a row. There it is. So that's our approach, basically. And I hope you've seen how this concept of optimism and realism comes together here in what we are trying to do. And I think where the value is for founders and for investors, VCs, everyone else, when a founder says, well, my revenue multiple should be 6, I always say to them, why not 5? And there's no answer. Why not 7? Also, hard to answer that question. When we're done, you can argue why it could be 5, 6, or 7, heck, maybe even 8. And there's actually stuff to point to and say, this is why I think this is what I'm worth, because here's the financial model. This is what it looks like. And based on a realistic, discount rate, which gives you a potential 10x return over 5 years, dear VC investor, here's what this thing is actually worth. So it's all about empowering people to have a much better quality conversation, to just take a lot of the information asymmetry out of the system. And we've done this quite a few times now. We've worked with, I can mention the University of Cape Town. We've worked with one of their startup incubators. We're working at the moment with a bunch of European founders as well on various opportunities. We had a great call yesterday with someone in the US. So I think this approach is resonating with people because I think it really goes a long way towards demystifying this kind of startup world where people don't really know what the value of anything is. That's kind of the general sense. And I think we try very hard to close that gap. So I think I'll leave it there, Graham, because I'm sure there's going to be some interesting questions, and I'll hand back to you.
100%. And I think, guys, I just want to touch on an anecdote from one of our clients. They were a founder who approached us, and without giving them away, but basically they'd been selected to go on to their version of Dragon's Den. And the guy's reason for wanting to have a valuation done was so that when he got asked the question in front of a live TV audience, he didn't look like an idiot, basically, because he knew it was coming. So, so the reasons for having it done, but that talks to the heart of this. At the end of the day, we want founders to be able to understand what the drivers of that valuation are. Understanding the drivers are far more important than actually understanding what the number is per se. So with that, I think I'm going to sort of dive into the questions that are coming through, and there are quite a few questions. So please feel free to add more as we go along. I think the first question, Ghost, is, maybe it's a question, does the valuation differ depending on which set of lenses you're looking at it through? So, let me explain that. So if you're a founder, would you look at the valuation differently as opposed to whether you were a potential investor, be it an angel investor, a VC, or even a later stage investor coming down the line? I mean, does that make a difference when you look at the valuation?
Yeah, so I guess obviously the joy of an investment, right, is you've actually got a natural conflict of interest. So the founder wants to raise at the maximum possible valuation, and the investor wants to get shares for the lowest possible valuation. And then you got to find something in the middle that works. I think what's also interesting is an investor will look at any startup as, well, almost certainly as part of a broader portfolio of VC investments. So VC is very much not eggs in one basket kind of investing. It's about building a portfolio of things that actually behave like call options. I put a little bit into 30 opportunities. Maybe that's too many. Maybe it's 10 or 20. And I hope that a few of them will really make it big, and the rest, who cares? So they'll look at it like that and say, does this belong in my basket of opportunities? And maybe they're willing to pay more accordingly. Maybe they're willing to pay less for whatever reason. The founder, completely different. They're looking to build out a cap table of the right sort of investors, and especially where a founder is going to need to tap into capital more than once, they will inevitably think quite carefully about who the investor is coming onto their share register at the end of the day, and whether or not that person is going to be willing to do follow-on capital raises. And that's also why I think having a proper strategic financial model is so important, because otherwise you get into the second year of your startup and you run out of money again, and you never thought you would. And now you have a look at your cap table and who's on there, and you think, sure, these are just angels who are not prepared to do follow-ons. I'm going to have to do all the hard work again now, and you end up with a cap table with a whole lot of different people on it, which comes with its own risks. So yeah, I think there are different lenses, and I think it's important for founders and investors to understand that. But obviously, especially founders, that's always where my heart kind of lies. I feel like investors know better, and often founders are doing this for the first time and are therefore at a bit of a disadvantage.
Fantastic. There's a question from Sia Ghost, and it says, does a service or consulting business get valued in the same way, I guess, as let's call it a product business, or a software as a service business? So I mean, I guess with a startup mindset overlaying that, I mean, maybe we can just kind of share our views on that.
Yeah. So the beauty of understanding the mechanisms of evaluation, that it actually all just comes down to cash flows and what the risk is of those cash flows, then you understand that the principles behind evaluation don't change. What's nice about a service business, or what can be very nice about a service business, is that it is typically recurring revenue, if that's how it's been built. If it plays in that kind of software as a service type model, then you have a scenario where margins should get quite juicy over time. You should have less in the way of management dependency once again over time. If it's more of a consulting business that is really based on people's time rather than a product, it won't get a valuation that is as juicy as software as a service in all likelihood. So it's about getting into the specifics of the business, but the overall approach to evaluation basically never changes, whether you are doing services or, dare I say it, whether you are a junior mining house getting stuff out of the ground. I mean, I don't think anyone thinks of a startup in that light, but junior mining is actually also a startup. It's about looking into the future. What will those cash flows look like, or what might they look like? And what risk weighting do I put on them? That is literally the whole concept of evaluation.
Thank you. I mean, I love the next question from Luther. And it says, what is the most outrageous valuation you've seen, and why, of course? So obviously we have to protect the identity of whoever, but I think in broad terms, guys, I think we've had quite a few interesting case studies along the way. So, what's the craziest one we've seen?
Yeah, thanks for the question, Luther. So the most outrageous value. Yeah. Look, I mean, obviously founders are all optimists by nature. And then even within the world of founders, there are realistic optimists. And then there are people who have not really cut their teeth yet in the real world. So I think with time in the real world comes experience. Adulting is tough. There are a whole bunch of non-PC ways I can describe it, but basically it's hard out there, and once you've been in the market for 10 or 15 or 20 years, you've kind of learned a lot of this stuff and you've seen the pain. So it is easy on a spreadsheet. It's very easy to just say, well, the total addressable market is enormous. I will achieve a 3% penetration on that market, which for some reason is kind of the market standard for these forecasts. And this is what my scale margins will be. And hence I will make a profit of $100 million in year 5, great. And if you do, amazing. Unfortunately, along the way, here are a whole lot of things that can go wrong. If it was that easy, every startup would just make a fortune, right? Everyone would have 3% of a TAM and away we would go. Unfortunately, it's not that simple. So yeah, I think it's when people have very unrealistic views on costs and revenue. And if you combine the two, unfortunately, you get to some really crazy numbers where revenue is just clearly very, very high, and people haven't thought about the constraints along the way to get there. And the cost base is very, very low. And people also haven't really given enough thought to what can go wrong along the way. Even stuff like costs of compliance, costs of dealing with competitors as and when they come up, it's difficult stuff. So we've seen some huge numbers, obviously can't give too much away, but in that you've got to then talk to the founder and get them to understand why you can't value the business on this basis until there's much more of a track record towards getting there. That's the important thing to do.
100%. And yeah, I say, yeah. So, I think we just do, we've seen valuations where the founder thinks it's worth $500 million and maybe it's closer to 20 or 30 million. So we've seen that magnitude of difference, and it's precisely that. It's things like haven't anticipated that margins will be squeezed down the line, or potential regulation. Once you get to a certain size, then the regulators get interested. So all those kind of myriad of things. I wouldn't say it's naivety, but it's those kind of challenges. Ghost, there's an interesting, not really a question, but a comment is, often founders get flattered by, a wonderful valuation. And I'm not knocking VCs here at all, but, a founder comes along and somebody says, oh, we think your business is worth, $100 gazillion. We want to invest in you. Okay. And it's flattering to stand around the barbecue or the braai or whatever and tell your mates that you've just raised at an X valuation. But what are some of the sort of, the things that founders need to be careful of when they get that very flattering valuation when they're raising money? I think that's something which a lot of people are aware of. It's those kind of hidden terms and conditions. I watched Shrek with my kids a few years ago, and I think they went off to Rumpelstiltskin. And, the sort of hidden clauses in those valuations, maybe just share a little bit about what are some of the things that founders need to be on the lookout for.
Yeah, so inevitably when you're raising money in this space, it's very much a private equity style transaction. Venture capital is really just early stage private equity. I mean, that's basically the difference. And these are negotiated transactions. So this is not like buying a share on the stock exchange where I can't go and negotiate with Apple because I went and bought their share, Whereas if I go and invest in a startup, then I can actually go and have those sort of conversations around the terms. And this will include stuff like obviously management involvement, appointment to the board. That can come with concepts around control over decisions. So sometimes this is what's known as negative control, where you can basically just stop things rather than start things. And it's basically like a veto right. Some investors will look for something like that. They might also have terms and conditions there around how they participate in further capital raises. So it's very much a case by case basis. And I think that in the venture capital world, there's a lot of specialization around this. So it is well worth having a law firm who specialize in the space to actually have a look and understand, especially where there are instruments like convertibles. So, under what scenario would this debt be convertible into ordinary shares? And what does that look like for you as the founder? Because investors love convertibles, right? It manages their risk on the downside and it gives them the upside exposure. They'll always push for that if you let them. So it is very much case by case. I think the advice to founders is just be careful. It's the same advice when you're selling your business, 5 or 7 years down the line. The devil is more than just in the detail. You've got to understand that this person on the other side of the room is not your friend. They are there to get a return on their money. And if it's at your expense, that's kind of how this game can work.
Yeah, and I think it's not just with founders, it often happens with things such as ESOPs or in employee share schemes, so you bring on people onto your team and you're like, oh, we're giving you 1% or 2% equity. Often with those schemes, the conditions attached to those shares are very different. And we had this discussion with someone in the US yesterday. You think you're getting 1% of a 50 million business or whatever it is. But the reality is that's, after, VCs and other investors get paid. And sometimes it's not 1% of the value of the business, but 1% of what's left over after, all the priority investors and creditors have been paid. There's a question. Go for it, guys.
No, I was going to say, I was going to address the question about the pivoting to B2B. I don't know if that's the one you were going to pick up on.
I'm going to go into that next. Yeah. So do you want to raise it and then
yeah. So basically, the question is essentially, got a £1.5 million valuation post money for a pre-seed raise in November for a software as a service portfolio of apps for B2C. Since pivoted B2B, additional desktop version, credible product market fit. So all nice, important things. Not yet creating recurring revenue, but immense opportunity. How would you go about valuing us for a seed raise? So look, a couple of important points there. I think the post-money pre-seed valuation, that sort of £1.5 million, What quite often happens with this is that VCs need to deploy capital, and they actually just have minimums that they are willing to deploy. So when you are very much pre-seed and you are selling an idea and who you are as a person, inevitably the VC is kind of looking at this and saying, okay, if I put £1 million or £1.5 million or dollars or whatever behind this person, is there a more than reasonable chance that they will figure out something cool to do with it? It basically works like that. Because what else are they really investing in? You've given them an idea and a direction, but they're investing in you. So you'll often see valuations of those sort of levels right in the beginning. Now, the first bit of money is the most expensive money you'll ever raise in your life, right? Because it's at the lowest valuation. So that's probably the most you'll ever dilute. It's the most expensive because there's the most risk. And then it becomes a journey of de-risking and proving out a model. And as you do that, you basically have more and more visibility over what your financial model is actually going to look like. And you should then be able to bring down the required return that someone needs in order to invest in what you are putting on the table. And that is how you get this flywheel effect on value creation. Is not only does the business start to actually become something that makes money, but it de-risks dramatically. And those cash flows, each dollar of cash becomes worth a lot more. So it's the same principle, how we would go about valuing it for a seed raise, exactly as we've discussed here. And I think the important point is to be able to prove that product market fit ASAP. And obviously, the quicker you get to revenue, the less you have to start the conversation with, well, we're not making revenue yet, but as soon as you don't need to have that conversation, then things get a lot easier.
Guys, I think there was a sort of question within a question there, or maybe not a question, but they spoke about post-money and pre-money. And I know it's a very simple term, but not everybody understands what that means. But there was another question around what's the difference between pre-money and post-money valuation. Maybe we can just touch on that before we move on to the next question.
Yeah, so basically the difference, if I buy a share in Apple, I didn't buy it from Apple. I bought it from someone else who wanted to sell their share in Apple. The money doesn't go to Apple itself. The money went to Apple way back in the day when they actually issued those shares into the market. In a VC world, money does not change hands very often between shareholders. It flows from an investor into the company. So what happens is the company balance sheet is now bigger as a result of the money flowing in. So you have to be careful when you're doing a valuation in this space to understand the difference between, pre-money and post-money. If something's worth $1 million pre-money, and then someone invests another $1 million, it's now worth $2 million post-money because there's an extra $1 million now sitting on the balance sheet, and that investor would actually have a 50% stake because they put in $1 million for something worth $2 million as a post-money valuation. So the reason this is kind of a well-known term in the startup world is because money in startups almost always flows from an investor into the business, not to another shareholder.
Awesome. There's a question from Luther again, and maybe it's not a technical question, but do we as BizVal ever get tempted to invest in any of the businesses that you work with?
Yeah, I love that. So look, obviously we see a lot of cool stuff. I think for me, what frustrates me is to see how poor some of the investment opportunities are in the listed space in comparison to, private companies. And now maybe I'm talking more to our traditional valuation products and more established businesses where you can pick up some really good stuff on earnings multiples, not revenue multiples, earnings multiples of like 4, and that's an earnings yield of 25%. Pretty much as long as it just goes sideways, you're doing very well. In the startup world, obviously it is different. And sometimes we do see some really cool opportunities, genuinely. I think what's important is that different personalities invest in different things. So just speaking for myself now, I don't think that I'm a natural sort of angel investor. I do like to see some progress rather than just rolling the dice on that sort of, pre-revenue, pre-everything idea on a whiteboard. I can understand why people do it, but I think personality-wise, you've got to understand who and what you are as an investor. I think the important point is BizVal has always been and will always be independent in these things. So we don't run money for people. We don't run a fund. We have no ambition to do so. And that's important because it means we're not conflicted. If we were also investors, then obviously we have a potential conflict of interest to make the valuation lower and then put in our own offer, for the shares. So very, very important. We don't actually do that. But of course, some of the stuff that comes through the door does look good, right?
Yeah, and I think that's an important point, Ghost, is that we actually had this discussion yesterday with someone in the US around, are you able to have a sensible discussion with both the founder and the funder? And that independence point is absolutely critical in that. We're not taking sides. So, and I think that's what makes us, kind of attractive to both parties in this situation is, you're going to get a honest, unbiased view, and that you're playing the ball, not the man, often in these kind of situations. I think there's a few more questions, and then we can wrap up. But one is a very practical one. What information do I need to have a startup valuation done?
Yeah, that is an interesting one. So look, you've got to have as good an idea of what you're building as possible. So, if you were pitching this to an investor, you'd have to be able to sit down and actually show them what the game plan is. What product are you building? What services are you building? What market are you hitting? How big is the size of the prize? I think that often the quality of answers then starts to deteriorate after that quite hard. So I'm always quite impressed when someone has really given proper thought to a route to market, for example, and what might that actually cost. Another thing that people often forget is what will be the running costs of this thing once it's built. They've kind of gotten an idea of, okay, what will it cost to build the product? And I can understand you've put your heart and soul into trying to just figure that out. There's not much headspace left for the rest. But you've also got to think about, okay, what do the unit economics look like once this thing is actually running? And how do I get to scale? So in terms of the information needed to actually get a valuation, I mean, you've certainly got to be able to talk through, what are you building? Why are you building it? When is it launching? What is it going to cost to build? And have a pretty good idea of what this thing's going to cost to run, what your route to market's going to be. It's all those sort of things are very, very important ultimately.
Awesome. And then I think if there are no more questions, it's still the last question. This is more of a techie question. There's a few more coming through now, but presumably you use a discount rate. For startups, how do you arrive at the appropriate or the fair rate, as this can make a huge difference to value?
Yeah, absolutely. So this is where startups become more of a forecasting risk issue, of course, than a sort of established business. And that gets reflected then in the discount rate. So the way a discounted cash flow works is that the higher the discount rate, the lower the value today of those cash flows. The discount rate is basically the return that an investor needs from the money they are putting in. Now, if you go and, buy a government bond, I'll just use South Africa as an example, that's a 10% yield. In the US, 4 and a bit. If you go and buy a listed company on a stock exchange, you're hoping to get kind of a double-digit return. If you're going to go do private companies that are established, then in a place like South Africa, you're looking for 20 to 25, sometimes 30% returns. That's why people pay an earnings multiple of 4, because if you invert that, you get an earnings yield of 25%. In startups, obviously, you need to get a whole lot more than that, right? Because the risk is so high. So if you go and you run the numbers, it is roughly true that if you want to 10x your money in 5 years in a startup, then you need to be doing a discount rate of like north of 60% if you go and actually work it out. So, from speaking to VCs and how they manage their portfolios and everything else, a lot of them are looking at, okay, can this 10x my money within a reasonable time frame? Not because that's what the portfolio return for them will be, but because they know they have businesses that will fail. Like there's not a chance that they're going to, throw money at 10 companies and all 10 work. I mean, that would be legend status VC. So the ones that work need to 10x so that the ones that fail, go to 0. And we take that into account, obviously, in our discount rate. Having said that, a business that is already making revenue, already has a good idea of its unit economics, it's still a startup in terms of the fact that, it might still be loss making, or there's still a high level of experimentation. They haven't yet solved the problem they set out to solve. Those discount rates can be lower. Those can be somewhere between pure startup land and, what you might pay for an established private company. And of course, this is where judgment is required. I definitely can't point to something and say, okay, for sure, the market will use a discount rate here of 45.398%. No one can do that. But what we do is in our final output, earlier I referenced the sort of sensitivity tables and how we think about this stuff. We'll show what the value would be at different discount rates. And what is quite interesting is as the discount rate gets very high, the sort of 5th year blue sky piece becomes less and less valuable because a cash flow 5 years in the future, discounted at a high discount rate, is not worth that much today. And that is why you see startups that are listed, because there are many listed startups, particularly in the US, with hugely volatile share prices and what's called long duration cash flows, because the cash is years and years away. And when interest rates went up and discount rates went up, those share prices crashed down to earth from sort of 2020, when did they peak? End of 21, I think it was, all the way down to the bottoms of 22, 23. It's because of what was happening to the discount rate relative to when the cash was coming. So yeah, long story short, we try and take into account a sort of 10x your money in 5 years on a high risk thing. And obviously that comes down as the risk comes down.
And I think, Ghost, you touched on it right at the beginning. You said that, you know, the more track record you have and the more street cred and credibility and all of that sort of stuff, in time you get that multiplier effect on valuation as the discount, even if your, you know, profit projections don't change, the discount rate comes down over time as you've got more track record, you know. So nothing else changes. If you revalue that business in 3 year time, the value could actually go up just because of the discount rate.
Should we do that last question?
I think so. I think the last one is quite a meaty question, so I'll leave it to you to explain the question and deal it, and then we'll wrap it up.
So the question is about startups facing different financing options. So your sort of typical term loans through commercial banks, concessional debt through organizations. So there's lots of different ways to do debt, right? Versus issuing equity, and then what are the impacts on valuations with the different options? So look, most startups cannot even dream of getting term debt from commercial banks. I mean, unfortunately, most small businesses can't even get that, because what the bank is looking for there, they're looking for two things. They're looking for interest cover. So do you have enough profits to pay the interest? They don't care about your revenue multiple. They want to see profits. And they're also looking for protection if something goes wrong. So they want to be able to look at an asset and say, okay, if you can't pay me, I can go and take that asset. You know, and unfortunately, your ping pong table in reception is not enough for them. They're looking for factories and machines and properties and all that sort of boring boomer type stuff, right? So that's not really an option even for a startup. I think when you get into more, you know, there's all sorts here. There's like grants and stuff, which may or may not be structured with repayments. There's all kinds of debt structures. There's convertible debt. There's all that stuff. Again, I would say it really comes down to the detail in terms of how this thing is funded. So if it's a convertible debt instrument, for example, then we would need to take into account the fact that someone invests in the equity today, but when that thing converts, and depending on what terms it converts, you know, they then actually get a diluted stake in the business versus what they thought. So then we need to be careful and say, okay, assuming this thing gets to the value we think it can get to in year 4, how much of it will you actually still own by the time things have actually converted? You know, if you have a scenario where you've got debt that is structured in such a way that it eats up a lot of the cash flows. So that might be something like a participating preference share, for example. Again, you need to take that into account, because we're trying to get to what is the cash flow to an equity investor coming on board today. And we need to try and get as close to that answer as we can. So yeah, we would need to take into consideration all of those specifics. But the high level answer is anything that strips money away from an investor to a funder is obviously going to hit the valuation in some way. Caveat to that is raising debt is always going to be cheaper than raising equity as a startup, which is why banks won't put their money in, because they can't get enough of a return on it from a startup for the risk they are taking. I think if startups could be funded by debt, they would all be funded by debt. You know, debt with coupons that are only paid in 5 years' time would be the dream. Unfortunately, it is just that. It is a dream.
Fantastic. Well, guys, I don't know if you've got any closing thoughts, and then we can wrap up. But I think, you know, I'll just say a couple of things, and then you can conclude. But I think, you know, there's a takeout from today, and as I said, we've got a couple of follow-on sessions in the next couple of months. Is that it's less about the number. It's not the sort of mystical black box. There are some real fundamentals, drivers, things that you need to think about as both a funder and a founder when you're valuing a business and a startup in particular. And it's really, really useful to understand what those things are. And I guess that's what we're trying to highlight today, is the outcome might be uncertain in terms of a number, but if you really understand what these drivers are, how they work, if nothing else, you will have a better chance of understanding how to grow your business into something successful, even at the startup stage. So that's kind of my key sort of takeout from this. Ghost, I don't know if you want to just wrap with any closing thoughts from your side.
Yeah, I think from my side, I'm excited to see, what we're doing in the startup space. I think it's something we ummed and ahed about when we started BizVal, of where we're going to try and get into this. And what I love is that I think we've come at it with a different angle. I think we've kind of brought that more Series C level thinking, and then brought it kind of all the way back to the different potential capital raises. And, I think that's really valuable to founders. I think there's nothing worse for a founder than going through a couple of early stage capital raises. Maybe they happen during a very useful time in the world from a macroeconomic perspective, and then staffing up and building out this thing and not worrying about unit economics because the money will always be there. And then suddenly it's not. Or you get to a Series C and people are like, no, this thing actually doesn't make any money. And unfortunately, there's been many stories like this over the past couple of years of founders that have been really caught out. To be honest, I blame the investors as much as I blame the founders, because I think the culture of zero interest rates kind of creates this culture of just build. Like, don't worry about whether or not it makes money. Just get bigger. Just get bigger and we'll be fine. Someone will buy us for the users one day or the size of the product. Actually, a business needs to make a profit. And I think that approach that we take, even if the offer that comes in for the business is maybe quite a lot higher or quite different to what we get to, I think the process of going through this valuation is incredibly valuable for a founder, because it really does start to put some pen to paper around what is the financial model for this business and where could the problems come in. And that can be the difference in 3 years' time between raising a Series C or retrenching all of those devs who you hired 3 years prior. And I think that's an important point.
Fantastic. Well, listen, thanks to everyone for joining today. Our next webinar is going to be towards the end of April. For those of you traveling over the long weekend, travel safely. And please remember that our webinars are available on YouTube, and share these with your friends and colleagues if you found this useful. So have a fantastic long weekend, and we'll connect with you all soon.